Good afternoon, everybody. As mentioned, I'm Brian Pascoe. I'm the Chief Executive of ICMA, and it's a great pleasure to welcome you today to the general meeting of the ERCC. I'm very pleased to open this event, my first in-person ERCC general meeting, but also more importantly, it's the first one, physical one at least, in nearly 3 years, the last one being in November 2019. So really good for everybody to be back together again. Of course, many thanks to Deutsche Börse for hosting us here in Luxembourg today as part of the GFF Summit. It's great to see such a fantastic turnout for the whole event. In a short while, I'll hand over to Gottfried, who will moderate a panel with 4 of our distinguished members from the ERCC committee to discuss the state of the repo market and the broader trends around collateral. This will then be followed by a panel of my ICMA colleagues who will update us on the various ERCC topics and initiatives that have kept us and certainly all of you as members very busy in the year. But before I hand over to Gottfried for the panel, let me take a few moments to briefly reflect on some of the key issues and initiatives that ICMA has undertaken and that you will hear about later. My tenure in this role is now almost exactly 1 year old, and I think just by way of reflection, I think what we do across fixed income, primary, secondary, and repo and collateral remains very, very fit for purpose. We obviously represent all industry participants and constituents. We look to advocate as well as to support best practice, and we are increasingly looking to broaden our geographic footprint. I think that model and that mission statement remains very, very strong and very important within the context of the industry. Increasingly, of course, embedded in what we do, sustainable finance, both from the purpose of operational efficiency and driving projects, but also more strategically, the work that we're doing increasingly around DLT, blockchain in the bond markets, and clearly that ties in also very importantly with repo going forward. We're also clearly looking to build out our advocacy in both of those areas and plug in where we can across the board. Repo and the ERCC work is core to what we do across the organization, and I think clearly will continue to be very important, be that on the regulatory side or on best practice, and certainly looking at internationalization opportunities from an association perspective. And that's something, again, that we'll touch on in a short while. At the core of the work of our repo work and ERCC more specifically remains the GMRA. This year marks 30 years since the first publication of the GMRA, and it's clearly been a huge success story for the industry. It's proved to be incredibly robust over the last 3 decades, withstanding the challenges presented by the global financial crisis, and is now deeply embedded as the core utility in the operational, legal, and regulatory ecosystem of the market. We now have legal opinions supporting nearly 70 jurisdictions also in terms of repo activity under the GMRA. Elsewhere, we clearly also are supporting internationalization and developments in some of the, market efficiency in emerging markets, mainly in Africa and Asia. Our close partnership with organizations such as Frontclear has been key in this in supporting the growing community of members based in those markets. This is something clearly that we will look to continue to build on going forward. Turning to fintech and digitalization briefly, we're involved in a number of key initiatives that are directly related to repo. Firstly, of course, the clause library and taxonomy project, which is now moving into phase 2, which is critical to future-proof the GMRA effectively by standardizing and improving efficiencies in the process of negotiating and managing legal documentation. The common domain model as well is something that many of you will be familiar with for repo and bonds, a joint initiative obviously with our friends at ISLA and ISDA, and clearly there are some synergies there between the CDM project and what we're doing in the clause library. We'll look increasingly to solve for interoperability and bring a number of these initiatives together to support efficiency in the market. We'll hear more of an update on the CDM later on. Obviously, in addition to fintech, as mentioned before, second and key cross-cutting theme for ICMA is sustainable finance. And here as well, we've seen very important developments in the repo space over the last year or two. Gradually, this has become an important focus area for the ERCC with our new Repo and Sustainability Task Force, which was launched earlier this year and now brings together more than 50 firms. We're certainly very well positioned to work towards a common understanding of the role of repo in this context and related key terms and concepts, possibly also relevant standards as we look ahead aspirationally. Finally, I think while the ERCC remains at the core of our repo and collateral work, we also have to acknowledge that a lot of what we do has extraterritorial impact on a global basis, and clearly the GMRA being just one example with the over 70 jurisdictions represented, but also in fintech and sustainability, which are of course inherently global issues. And therefore it's very significant, a number of these initiatives for ICMA's broader membership around the world. It's key that we continue to focus on capacity building and standard setting in the international markets. With that in mind, I'm very pleased to confirm today that we have decided to create a new forum, ICMA's Global Repo and Collateral Forum, which will be open to all ICMA members. We think of the GRCF as fully complementary to the well-established ERCC structure, which will of course continue in its current form. The GRCF will be one additional group that will hopefully add value to members both outside but also within Europe. But ultimately it will of course be up to our members to fill this group with energy, focus and ideas. You'll hear again a little bit more on this as later in the session as part of the ERCC Initiatives panel. So with that, let me thank you again for attending today, but also for your focus on the ERCC's work and also your broader support for ICMA. With that, let me hand over to Gottfried to host the first panel.
Okay, thank you, Brian. I'd like to thank you for your support for the European Repo and Collateral Council. I know it's cost quite a little bit of money to support all the initiatives, and I'm glad there's quite a few of you here in the audience as well. I also like to thank, no, that's too far, wait a minute. Here we go. I also like to thank Clearsim and Eurex to host us once again. I think it's very convenient for us, even if it was missed and a few people had a lot of trouble to get here. Thank you for coming. Today we're going to have a little bit of a different panel because we're going to do a deep dive into collateral eligibility, a challenge that should be understood by all. However, only last week it was again clear that only you, the insiders, have a clue about the value, the necessity and the role of the collateralized market, specifically even the role of the repo market in our modern financial markets. And why do I make such a bold statement? Well, you have heard in previous meeting the Gordon and Metric work that highlighted that repo was called the crisis in 2012, the evidence of a generalized repo run. And I think that was totally wrong. Last week I got from University of Amsterdam Center for Law Economics saying that European legislature considered that a legal framework to facilitate financial collateral transactions such as repurchase agreements, security lending and derivatives would contribute to the integration and cost efficiency of the financial market as well as to the financial stability of the system. But since 2007-2008, global financial crisis, international legislators and policymakers acknowledge the major role that collateral transactions may play in connection with undermining rather than promoting financial stability. More specifically, repo were instrumental in the failure of Lehman Brothers. That's also not correct. Thirdly, in the Financial Times of 6th of September, it reads, Europe's power producers run short of cash. So who's going to fill that gap? In the Financial Times, in the Bloomberg on the 7th of September, the Norwegian energy group Uninor estimates European energy companies, excluding the UK, will need $1.5 trillion to cover the margin cost of the gas price exposure. And then finally, last Friday, the Financial Times article from Gillian Tett, Brussels must act to quell derivatives risks. Gillian Tett doesn't even know what repos do and how important. She doesn't actually like them. And she doesn't like me either, but that's another issue. So let's move on. Before I ask the panel to intervene, I have a few slides to take you back to the early 1990s when France and Belgium became the first countries to introduce repo markets. And the last country that followed was the UK. Preparation by the European Monetary Institute saw repo as a preferred market instrument, later adopted with the launch of the ECB and the euro. And as I got involved in the repo market, a market participant, and I can't remember the name, I have the age to not to remember those things anymore, he gave me my first lesson, and what a good one. And you see it on the slide. You have good counterparties, good collateral, you're the good guy. You're good counterparty, bad collateral, it's a little bit ugly. When you have bad counterparty and good collateral, it's the same, it's ugly. But if it's bad and bad, I don't think you should touch it. And that's something that we have seen many times. People get too far, and then, of course, you get shot by the bullets in the bank or wherever you work. So, a second thing. 25 years ago, the Swiss National Bank, together with the University of St. Gallen, created this definition. I have shown it so many times in the Commission, in the European Parliament, and I believe it's still very accurate. You look at every word of it, right? Optimal management of credit, collateral, capital, related execution, pricing, operational, documentation, risk management of a portfolio, and I look together and others across all products, all business units, and all locations. So that's why, thanks to Ulf, we still have this slide from 20 years ago, repo and money markets are at the heart of any financial institution, buy side or sell side. Basel has driven us towards liquidity and collateral management, and we have developed many tools, electronic trading for repos, use of central counterparties, but also lately the push by regulators for mandatory clearing of collateralized and uncleared transactions. Underpinning the repo market, as Brian has said, ICMA has supported the GMRA 95, the 2000 version, and the latest version. All this supported by market practice, championed by Sylvain, who can't be here today, and this market practice book is getting bigger and bigger and bigger. It will never be finished because it's a living document. And I'm proud of the achievements of the GMRA. The legal robustness of this document has weathered all the storms. Even if today looks bleak with the energy crisis, I'm confident the GMRA will continue to spend all financial instruments as it is the base of liquidity for the buy and sell side. The next slide shows the repo survey that was conducted in June, and Richard will talk about this later, but it shows you that it's growing, and it's growing also because of the uncleared margin collateral requirements now, but this is a repo market who actually fulfills the task of getting initial margin and also make sure for the variation margin. And as I said, in the energy, we're looking for 1.5 trillion. I had a call with some officials yesterday afternoon, and they're fixing it. But they will have to fix it with potentially a change of how the banks can transmit this without impacting the balance sheet of the banks. So you will hear this in the next few days. I'm confident this will go in the right direction. Now, collateral is a new cash. And I've managed the ERCC for more than 20 years now. And one remark from somebody you know, Greg Mercouzios, stuck in my mind. When all eligible collateral schemes fail, you will fall back on cash. And indeed, I have some done trades in the time of Australian dollar collateral, which I couldn't deliver against Australian dollar cash. So we had cash, which was basically a useless exercise. And that shows you that we still have to work much harder on the infrastructure. Not much has happened, you would think, if you look at Giovannini's report, as I said yesterday in the private forum here. But a lot has happened. We have Target 2, EMIR 1, CSDR, all the good stuff we dream about. In French, it's rather a cauchemar, a very bad dream. So, this is the last slide before I go to the panel. The first is global disruptive challenges. For the younger generation who followed recent market turmoil, they might say, wow, what's happening? There's nothing wow about it. Since the creation of the ERCC, we have been challenged many times. And thanks to the work and brains of our association, we have always found pragmatic solutions. The most recent event was, of course, the Russian sanctions, when suddenly Russian bonds have frozen. But in the meantime, we have noticed that the banks, institutions outside Russia have compensated with approval from some authorities. I think that's good. Second, we have regulatory intervention. The tsunami of interventions, of course, and the wrong-informed academics calling a run on repo, when there was no run, the liquidation of collateral that created the run on repo has not actually damaged the repo market. The repo market functions till the night before Lehman went bust. And I know it, I worked for also with Trioptima, and they actually were called by the Fed to actually do what you call it again, a compression exercise. That shows you that the repo market never failed so far. And then market evolution and initiatives. The market never sleeps. New initiatives, we heard about them today. Cryptocurrencies used in repo, central bank digital currency, the use of APIs. It will force real-time settlement in commercial bank money as well as central bank money between the ICSDs, I hope. Then we have ESG, ECB, ESRB policy recommendations. Look at this, the impact of the financial markets on climate. And they're looking at non-existing macroprudential tools to tackle climate risk and adopt systemic risk buffers to cover multiple sectors, like the energy, as we have seen. So many new initiatives, some use, some not, like QE, QT tightening, TPI, transmission protection instruments. Are we not really overstretching the industry? What about the buy side? What about the widening role of CCPs? And to discuss these various bullets, I have invited those 4 panelists, and they will help us in digging a bit deeper in collateral under the Shetland House rule. So Gareth, has Christmas come early? Is the repo market functioning like it had to be? Or do we have real big problems like we discussed in the committee meeting last week? The floor is yours.
Well, look, let me start off. I think the mood was certainly quite nervous last week when we had our discussion. We're entering obviously this new paradigm of higher rates, right? We've not seen this for a long time, and the market needs to find a way. And I know we've talked about problems around collateral crunches, shortage of collateral for many years. We see many problems at month ends, quarter ends, etc. But even now, right, we're only in September, and we're already starting to see, a significant number of inquiries from clients over year end, wanting to lock in financing balances, wanting to place cash over year end just for the certainty. So I think there's the next few months will be quite a test, and I think we've seen some of the repo rates, even today, and in the last couple of days in the market, some kind of craze. It's almost as if the rates went up, but repo rates didn't. And maybe we can get into some of the theories around what might be happening. But I think one thing's apparent, over the last few years, all members of the financial industry, buy side, sell side, are now trying to operate as efficient as they can, right? Efficient from a balance sheet, liquidity perspective. So banks don't have big stores of collateral. They don't have big piles of cash that they can just lend at will without considering all of the capital costs. And that drives some of these big moves in pricing that we're starting to see, or we see very regularly now. It's just kind of feels more like a norm to me than a panic.
And Emma, you from the buy side, you see history repeating itself quite a few times already. What's your perspective on what you heard from Gareth? Is it really that bad? Surely you, by which I mean BlackRock, can always find liquidity to do your trading?
Yeah, absolutely. Look, we saw the ECB meeting last week. It was very poignant for our market, given the potential impacts. The fact that they even referenced the repo market in their statement as well. I think there's clear pressures within the market. There's no doubt about it. I know we're all here, but markets are not behaving in the way they should today since the new maintenance period. So, there's definitely, we know there's a demand for collateral. There are concerns in the market. I think from my seat, I'm always looking to just manage the risk around these reporting dates. I'm always trying to access liquidity as best I can. I never take it as a given that we can access liquidity. We're very fortunate in our kind of place at the table, but I'm not complacent. It's so critical that we understand the market dynamics, and I'm always looking for additional liquidity, whether it's bilaterally, whether it's these additional tools that we continue to kind of touch on. But, I always say in I know you all know me very well, but, you know, the worst thing for us is actually for me to be the last call. So, you know, the position that we're in is a good thing, but it's also, you know, a position that could potentially catch me off guard. So, you know, it's my job to make sure I'm always one step ahead and I have that plan B. We all need a plan B in a professional and a personal life, but, you know, that's kind of where I sit on that.
Thank you. Thomas, you weren't present, but we had once David Roux from the Bank of England and colleagues who came in because I noticed that the banks had reduced their trading in repo. And when we discussed this, we told them as banks that we wanted to reprice the market. It was too cheap. In other words, why would you use repo as an instrument? Because the cost of money for the bank was too high and the buy side wouldn't pay up. Is that still the case now?
Yes, is the honest answer to a certain degree. We're still fighting that it's not a battle because we have to do it together, but margins are compressed for everyone. So I think the banks were just the ones who felt it first. So we were the one that were absorbing a lot of the costs that came in for making repo more expensive, for implementing the regulations. But I think it's also now hitting buy side more than it did at that point in time. Because I remember this conversation being referred a few times. So I don't think it's a case of the different parts not being aware that it is more expensive and that there are some costs to be passed around, but it's very difficult because you have certain parts of the ecosystem where the margin is just what it is. They have very little to give. So we're kind of passing around the hot potato a bit. I think where we've come very, very far as an industry, and this organization having opened up to both sides buy and sell now, is that we have much more power in front of the regulators to tell them that when they're trying to put brakes on the machine running too fast, they need to calibrate them, because otherwise we start veering off in directions where we don't want to go. But they're still not paying.
Enough.
But so they're paying some, but not.
Yeah, but everything has to start modestly and then it grows, hopefully for the banks who are actually being put on the side a little bit now and then, I feel.
I think we've also been very used to having sort of unsecured rates quite close, at the short end anyway, quite close to secured rates, just because of the fact that rates have been so low, margins have been compressed. And I think as rates rise, you know, we're kind of going back to a bit of the old world, you know, like beyond 10, 15 years ago, where if you want to secure your money, it costs you. You know, there is a true cost to do that, which I think has almost been forgotten, I think, sometimes.
Yeah, at that time, 20 years ago, when the American firms were actually paying more for secured than unsecured money, because they had no access to the unsecured market, and I think that has changed a few times already, no?
But I think we also have to remember, when we talk of it as a cost, it's not a cost in the sense that somebody is charging you that cost and therefore making it as a profit. It's a clearing price. Yeah. It's a supply demand. It's a finite resource. So it's not that somebody will have a higher profit in this game. Of course, we know that. But by and large, it's just the clearing price between those two things starting to diverge, because one is in shorter supply than the other. And that's kind of just is what it is. A price is a price.
Absolutely. I think as we collateralize the market, whether it's derivatives and uncleared margin or repos, secured lending, as you collateralize the market, you are taking out risk, and if you take out risk, you should get lower returns. That's, you know, to me, that's
makes sense. And that brings us to JR. You know, we have finished now the uncleared margin rules, number 6, or we're in the middle of it. Moving from phase 1 to where the CFIs are now replaced by a few CFIs by thousands of other participants. And did you notice increasing there was some movement in collateral? And was it costly? Did you do additional work for that, or did it go smoothly without any hiccups?
I would agree with we have finished the UMR implementation, you know. In our industry, we were impacted by a number of regulations, EMIR, SFTR, CSDR more recently, and UMR for the last 5-6 years in waves. So we just finished the UMR phase 6, 1st of September. However, I don't think it's finished the exercise for most of our firms, being service providers like we are, or market infrastructure and market participant. Indeed, it moved from the top 20 accounts or the top 20 players, dealers mainly, to have to collateralize each other 5 years ago to up to this year, where at the end now we have nearly 1,000 new participants in collateral management activities for margining. So that was a huge exercise. And accounting for so many new participants in tri-party agent, in collateral agent, which have offered a service to support their clients. So that was a big challenge for the service provider side, but also individually for each of those clients. You know, for some of your big firms to implement collateral management for margining, okay, challenging, but you're used to that. For a large number of buy side which came to that, we had Roelof sitting here this morning telling us that his margining requirements increased by 10 over the last recent months. So that's a big challenge, not only in terms of implementing the regulation, and with SFTR, that was the cost. You had to find a solution, implement it, and then there was a bit of maintenance cost to continue your reporting and your trade repository fees. Here, with UMR, the cost for implementation is there, new system, new partners, new collateral agent, whatever, implemented with all the counterparty, but then you have, and I fall back on the collateral cost. Now, UMR has already consumed up to date, and when I say consumed, it's immobilized over 300 billion of collateral across all the participants. You know, the vast majority is on the top 20 dealers, but now with the big buy side, which are unidirectional, now we have some large buy side pension funds, which in terms of margin requirements are as big as the big dealer. And so those 300 billion of collateral must be missing to some people, because those, I can tell you, they are on accounts in collateral depositories like Clearstream, like Euroclear, or other tri-party agent or collateral agent. And that's the real cost to that implementation. And that's not over, because those 300 million will keep building up from now on for a long time. So there is definitely room for continuing that exercise, because now at the moment with the deadline is passed for the implementation. I think it was challenging but successful for most participants. There are still people which need to get involved, but they were not called for margin yet, so they still have a bit of time before they reach the minimum threshold. But what will start now, I think it's a kind of an optimization exercise to reduce the cost, because I think for many firms that represent a significant cost. As I say, in terms of the fees paid to service providers, systems and so on, but also in terms of providing collateral of the highest quality, and that we mentioned that this morning. I think for any firm which can replace HQLA by equities, for example, in collateral margining, that's a benefit. We heard it this morning. Scarcity on GC and HQLA makes it very pricey, where there is ample supply in other type of collateral. So optimization in the asset class used for those margining. I think there is room for more clearing. We heard about mandatory clearing for some derivative coming up, compression and innovation as well. So, but this, I think, will continue for a number of years, and there will be room for a number of new products, services, and solutions to optimize the collateralization of UMR, but also many other requirements of collateralization.
Okay, thanks.
I think the other factor as well is you've got unprecedented market volatility and market moves in various markets, right? So you can't forget the VM components in the derivatives world and add-ons for initial margin. So these are, you know, because of that geopolitical environment, you know, you're also seeing it like almost like a magnifying glass over this new collateral requirement as we go forward.
Yeah, okay. Of course, I mentioned the IM component of the UMR, but of course, even clearing margining has increased dramatically. If you look at the ISDA survey, you know, the amount of collateral which is mobilized for margin by CCPs worldwide, you know, it's much more than that. So if you add them up, you know, we are talking about trillions of collateral. So it starts to eat up and maybe fuel to some extent the repo market. Richard Komoto will tell us about the new figure soon, a bit later, but that's definitely playing a role now and adding to the scarcity of collateral.
But all this was kind of expected to come, right? But then we have those disruptive challenges, like the Corona crisis, you know, at home, Zoom, Teams, you know, till we were sick of it, and I'm luckily we can be together again. Then we have today's current energy crisis, which is probably much bigger than the Lehman crisis. And then we had the Russian sanctions, the start of the war, and the blockage in the system. So how did that go for you in the group, Russia?
Russia in particular, well, crisis in general, I like to believe that financial market infrastructure, at least in Europe, in the States, are extremely resilient. That's part of our DNA. So our product and services are built, designed initially and built for extreme market volatility. So through the crisis you mentioned, we have not encountered, be it from trading, clearing, or post-trade, any specific outage or challenge, because hopefully the market infrastructure is built for that, and that proved to be right. So that was very positive. On the other side, more specifically so that was the case for volatility triggered by the start of the COVID crisis or the start of the war. But, so where more challenging, of course, is the Russian, with the Russian sanction, as you call them. So the sanction in general, that's not a question of technology or scale or resilience of systems. It's about a qualitative approach. So what do you need to get the information, interpret that information, which is sometimes very challenging, and then implement it the best way possible, the fastest possible to be on time, but also taking into account clients which get caught into a very difficult situation sometimes, and we have seen that this time. So hopefully not too much damage, but unfortunately that's something. Sanctions are like law implementation, so not negotiable. So we have to do it, and so that's a more. It's not about resilience. It's about really implementing sanction the fastest way possible, but also in a fair way, so that clients have a chance to at least square the position and potentially get out of it at some point.
And for Gerrit, Thomas, and then Emma, we have now seen the sanctions in Russia. Is this now part of your risk management in your institutions? Future, you don't know. Yeah. I don't know what's happening, right? But
yeah, I think all these things are on this topic of resilience, right? You've got systems and infrastructure resilience, but there's also the people side, where I think the last few years there's been one geopolitical crisis, or there was the pandemic, one thing after another. I think the market has been very, very resilient, and the people have been very, very resilient in coping with this. The speed that everyone quickly turned to working, trading from home. What I would call like the financial part of the pandemic was very short-lived, I think, until the central banks came in to kind of save the day. So I think the markets, from my eyes, are very, very resilient. But one thing we expect there to always be something else that is coming, right? And it's going to be big, and it's going to be unexpected, and we're not going to be able to plan for it. But what we have done is we change the way we risk manage everything we consider in any transaction. Any new business that you're putting on the book, you're thinking, well, what if? And no what if scenario is I remember years ago, you would have a conversation with your risk control colleagues, and you'd be, that's a crazy stress scenario to put on the markets, whether it's like a rates shock or a credit shock or something, then the rates moves just in dollars early this year, right? So we blew through all of the stress scenarios that were, this is how fast dollar rates could move, and then suddenly it's like, actually, it's just normal now. So you're expecting something, we just don't know what that something is, I think.
I actually think that, through COVID, it actually made us better at managing risk, because now we are having to adapt and kind of plan for these unplanned events. Yeah. So I actually think it has actually shaped us to be actually better risk managers. And, just talking about sanctions and how we kind of coped, I think, there were lots of challenges around it. And I think one of them was just the common interpretation of it was, challenging to navigate, I think, operationally as well, and how we were going to manage that. And also, I think, and ICMA have done a great job, and I know we've spoken on the ERCC a lot, is just, I always say, if there's no joy, learn the lesson. And I think, we continue to have to just learn the lesson from these events and then adapt and change and make sure we can, whether it's best practices, standardization in the market, but again, just forward planning for that next event and learning we could maybe potentially do better.
And I think one of the things that's really encouraging is that compared to 10 years ago, it's certainly my experience again that buy side and sell side are much more on the same page. So when you go through transactions which are out of the ordinary or you're establishing new relationships, there is no topic that you cannot discuss if your counterparty is in a certain jurisdiction or region, or the assets in questions are outside the normal thing that you're used to. There's no, or we can't ask that question because that's an unthinkable event. That will be offensive to ask, right? No, you can put everything, and both parties are interested in having as much certainty as possible, and also then be clear about what do we do if we get into that space where there is no certainty. Do we have some sort of get-out plan together where we need to move, or where 10 years ago it's like, that's never going to happen, we don't have to worry about it, so don't write anything in the contract, right? That doesn't happen anymore.
Yep.
So
I see this going beyond I think the kinds of conversations now, it goes beyond like what would call like the first order economics, where you're not just discussing what the rate is, maybe the haircut, etc. And, you know, you're looking at stability, like is this stable? Is it good for the market? Good for market stability? You know, what could go wrong? You think much deeper than just the first order economics. It's about kind of, you know, are we doing the right thing here with this transaction? And you saw that in the credit space as well, where you saw, you know, counterparts having real credit issues over the last, you know, 2-3 years, depending on what the event was. It's not, you know, okay, well, the best thing for us is you just close out, you know, that's what the GMRA gives you, you know, don't lose money. Now it becomes a conversation, is this good for market stability if this happens, if there's fire sales, if there's a potential trigger that collapses a whole market segment, for example. These are the kinds of things which get openly talked about now, I think, in some of these discussions.
And so all the way behind all this, we have the regulators, right? They want to regulate. At one stage, I thought they were catching up. I think they kind of lost speed. But in the meantime, they sometimes introduce contradictory regulatory requirements, right? Like NSFR doesn't make any sense. So, Thomas, what do you say on that? How should we look at that, we as an industry?
I think we have to accept the fact that the regulator is always on the outside looking in, yeah? Which means they don't feel the pain the same way as we do. So in all instances where they come up with some regulation, it's because they have an idea of making things safer. And so, but you know, the road to hell is paved with good intentions, some people say. For us, it certainly sometimes felt like it was ridiculous, not well thought out, but leave that aside. We have to accept the fact that they try. They don't understand perhaps as much as we do. They don't see the effects straight away. And we sometimes don't either. But I think we just kind of have to get on with it now. And then we have to be, they know more as well. So we need to be perhaps a bit more assertive with them and say, no, you are actually wrong on this occasion. Because on one hand, we have, since you mentioned the Giovannini barriers, right? And all those safe type of discussions about compartmentalization, fragmentation of markets that we're working on all the time to get more fluidity in the collateral market because we want it to be more cash-like and get a certain velocity. Everything that they do slows down the velocity. Yeah. Now, it's sometimes because they want to make things safer, but I made the car analogy earlier on. If it's only the front left wheel that starts braking, the car goes in that direction, right? That we need to be clear with them about what the consequences sometimes are, because they do. The NSFR seems like an extremely blunt instrument, but banks have it, others don't. That creates friction, right? It creates frictions for us. We can't do the same maturity transformation that we used to do, which means there's certain collateral asset class transformations we can't do either. That slows it down. That just does mean that the even in the extreme case of whether or not that's a second, third, or fourth order effect, is that the transmission mechanism of the monetary policy sometimes probably doesn't work the way it's expected to because of these frictions. And at certain times it's more frictional than others. The last couple, today, I don't know, we'll probably see in a couple of days of what has happened, but my gut instinct is that there's a big block of something that's in the wrong place. And it's then suddenly discovered, and because we're not used to reserve period maintenance and different cash accounts and all this, that somebody might have been called out somewhere and doing a shift. And that's a good example of fragmentation and not being connected well, and something that was suddenly gets pushed goes in the wrong direction.
That's actually a good way to get it. You know, we work together. You chair with Emma the ERCC. I help it behind the scene. But in your bank, such a huge bank, how do you connect all this internally? Must be huge. Is it connected already? You don't have to say yes or no.
Yeah, look, the whole connectivity and connectivity of collateral, it is very, very difficult in a big organisation. Anyone working in a big organisation knows the challenge. You know, and I think your picture, you know, doesn't give it credit, right? The complexity of the number of desks trading different types of collateral in their day-to-day, repo desk sitting in the middle, funding, financing that collateral, maybe internal netting, you know, using longs over here to cover shorts over there, and what the implications of that from a liquidity perspective. You know, transforming that collateral could be tenor transformation of the collateral. So all this is really complex, right? Every firm, I think, is trying to do this, and you have to. You have to do it because, you know, this is the only way we can become more efficient. And I guess, you know, to some of Thomas's points, right, you know, yeah, regulation has been painful, and maybe people will shoot me for saying, you know, but I do feel the markets are safer, right? They do feel safer than a decade ago or more, but it's been a rocky road, right? It's been a painful journey. And then the counter side is, you know, you're always going to get then financial institutions looking for a way to then optimize the economics. You implement the regulation and then you optimize some economics, and then this is what happens. And they can't get it right every time it's out, because as you say, right, they're mostly looking from the outside in. They're trying to implement something, but then no one can really foresee the first order, second or third order effects of some of these things. But you're right, Godfrey, it's a really complex internal landscape. It involves, you know, investment in technology, investment in changing processes and people, and just the approach and mindset, right? Just being more quantitative around the way we think about it.
So Emma, it's probably much easier on your side, no? You're only an asset manager. Easy, no?
Look, and I said it on the panel this morning, you know, bank intermediation is so key for our business, and bilateral repo, I think, is where you'll always get the most liquidity. And we are seeing, you know, this impacted in the role of the bank. Obviously, regulation is good and it's done with good intentions. I do worry sometimes about the unintended consequences some of this regulation has. You know, an example from my seat is just the regulation around, you know, European money market funds, you know, not being able to use a CCP. So, you know, that is something that I do believe is unintended, but it is impacting the market. I mean, again, thinking about regulation and, you know, my point around bank intermediation, and maybe cheeky to put you two on the spot, but I do worry, even with regulatory relief, you know, whether that would actually translate into client kind of business. Sorry.
To me, right? So
we didn't rehearse this part.
Sorry.
Are you looking for a promise?
The impact of regulation, right, that makes banks, you know, either provide less liquidity, or there's, you know, there's a certain amount of pricing that you can they can do. But sometimes it gets to a stage where there is no price, right? Nothing makes sense, and this is going to affect the buy side. It's going to filter through into the buy side. It's going to make, you know, cash reinvestment rates drop potentially. There might be less kind of activity that can be offered, right? Maybe money market funds become simpler, they become more expensive. This will have an impact, but to me, this is the impact. We I think do our best as a you know, banking community to provide the liquidity we can provide within the rules, right? But and we do try and help shape the rules. You know, we do a lot of the lobbying that we do through the ICMA. You know, it's where we think things don't make sense.
No. We don't lobby. We educate.
You know, education.
But I think it's just articulating, you know, the challenges we're having.
Yeah.
Yeah.
And yeah, I think, again, and I said this earlier, is just, and that's why we're seeing more and more off-balance sheet kind of solutions coming to us, whether it's cleared repo, whether it's peer-to-peer. So, you know, there is a lot going on in the space of alternative solutions to bilateral repo. So, you know, we have to look at these options. You know, like I said earlier, you know, my risk is that I can't grow the business. My risk is I can't get access to liquidity at year end. You know, so there are these risks that we need to manage, and we continue to need to get access to that. So, you know, these products potentially are going to evolve over time, but we're still evolving.
Like it was said this morning, right? The pension funds have an exemption for mandatory clearing, but you know, that's maybe 1 more year, and then the hammer will come down.
Yeah.
And so, you know, one thing I remember when David Hardy started LCH, Central Counterparty Clearing, we thought all the clearing and settlement problems are gone, right? The CCP will do this, and in fact, nothing happened, right? We have the same problems in CCPs. When the buy sides will now be pushed more and more in the CCP, what do you see as an impact, Emma? Is that possible for asset managers across the board, or is it?
For us to put more into the CCP, yeah. I think, again, it's just it's implementation, right? I think the biggest thing for us is all these different solutions, and it's the resources. So, you know, I would love to have access to everything. But, you know, picking that one that you can get those resources behind and implement, you know, if it needs a tech build, it's on a long list of other things that the firm needs to do. So, you know, look, people are using it. I know my colleagues are using it. You know, we definitely see the benefits of it. But at the moment, for me, the hurdle is really just implementation.
Sure. One of the impossible to be implemented was the mandatory clearing regulation, right? CSDR. But you have now with
mandatory clearing was EMIR, mandatory buy-in.
Okay, CSDR, right? Mandatory buy-in and the penalties now. Do you think was this on your side a challenge? Was it misplaced? Shouldn't it never have been with you? Just because we have CSDR update anyway, right? But just give us a flavor what it means for your organization.
Well, for us, Clearstream as a CSD, you know, mandatory buy-in or penalties for cash penalties for failed settlement was the least of our concern, because CSDR include many other requirements for CSDs, but that's only visible to CSDs and not to the market participant. But for that part, on the settlement discipline, you know, exactly what Thomas said, you know, the good intention from the regulator, improvement, you know, settlement efficiency is a topic for us in the Repo and Collateral Committee for years. We are still working on it. That'll be reported in 15 minutes. So that's key, and that regulation should help. Mandatory buy-in, was it the right tool? At least the market has convinced the regulator that at least we should put that on hold or freeze it for some time. But no, as a market, we need to behave and prove the regulator that, you know, they were right to put it on hold and freeze it and maybe store it for good. We need to fix the remaining issues we have in settlement efficiency, and that's a concern for everybody, not only for the market infrastructure, not only for market participants. Everybody needs to get involved, and that's a discussion still had last night, late in the bar. You know, what can we do for settlement efficiency? We discuss before we get to mandatory buy-in, shaping, partial settlement, auto borrowing, those kind of things. We discuss at length, and at the end, maybe we should, to the regulator, maybe we should lobby to trade off, you know, a complete abandon from the mandatory buy-in, but against mandating maybe shaping for OTC trade, not only for clear trade, because that's done by the CCP and that works. Yeah. And we see in the US it works as well. They've imposed shaping, and that works very well. So we should do the same on the European market, and partial settlement is now nearly available in all CSDs and ICSDs the same way. So pretty soon we should be able to implement strict partial settlement, which would be similar everywhere. So why not maybe potentially implementing that and mandating it?
Great.
So that it's not that I want to give suggestions for new mandatory regulations and so on, but you know, maybe that's the worst of the both evil. And to be fair, to come back on the cash penalty question you have. So far, fine, it works. Penalties are being held and so on, but it's not penalizing enough.
I think it's good to see, though, in our working group, so we talk about settlement efficiency, though, the mood has changed from what should we do, and I think that's been, what's in our control, and I think that you've been very clear, JR, about the things the market can do around partialling, shaping, etc., auto-borrow programs and things, and now it's changed to, like, how do we do this? How do we implement this? What do we need to do next? What are the next steps to make this a reality? Because we know that it will increase market efficiency of settlement. And then there are things we can't control, which are, to me, still the settlement landscape in Europe. It is very, very complicated, very complicated. Many, many CSDs, ICSDs, all of this collateral that is within our firms, within our different legal entity structures, within our different trading desks, is also sat within different physical boxes and accounts, all across Europe, all across the globe, and then, part of the challenge is, getting that inventory into the right place. It's not just a trading challenge and an optimization challenge. It's also, it's a settlement challenge to me as well, just as much as it is the front.
When I had the first chat with JR about this potential panel, you came up with a list of initiatives, right? Trading or no post-trading. Can you give us a quick overview of what you see on your side? Because I can't follow this anymore. It's far too many.
You were challenging me on the whole infrastructure, which create all those problems. So to be fair, if you look at I have to contradict a little bit, Gareth, but that's why we have panel, to contradict each other. So indeed, the settlement landscape in Europe still doesn't look exactly like the one in the US, where we have only two platforms, Fedwire and DTCC for all assets. So that makes it a bit easier.
That has its problems in itself, right? You think about credit and some of the intraday credit problems we've seen in the US. Having all settlement through one location is also potentially not a good thing either. Mm-hmm. It's almost like sometimes there isn't one perfect solution.
Exactly.
To this.
So those discrepancies between the different markets and so on have been maybe used and leveraged by some parties for a long time. But in terms of the old infrastructure, let's start with the public sector. Not talking about market infrastructure like we are, so private ones. So if you look at the ECB, what they've done and delivered over the years, so I know they're long. Market infrastructure is like putting rail on the ground to move trains, so it takes time. So T2S has been delivered. Now we are moving towards where the harmonization between Target 2 and Target 2 securities, so into one single platform. So that's an improvement. So we have the TIPS, which is more for the retail banking sector, but instant payment across Europe. That's a progress of market infrastructure. So that's not old infrastructure. That's brand new infrastructure. Then we have ECMS. So now this morning we talk about the problem of European central banks or European national central banks lending their assets all through different ways. Maybe a start of a solution next year, they will implement ECMS, so the European System Collateral Management System. So a unified collateral management platform for all national central banks of the Eurozone. You can just hope that they will continue that with having a single securities lending system for all of the national central banks and maybe a single interface to access it. Collateral management was maybe the right thing to start with, but SAC lending would be benefiting from that as well, so giving all market participants an easier access. But at least there are progress there on the infrastructure side. So that's the public sector, and with just a few examples. I know it took 10 years, but that's not old technology anymore. It's a brand new system and platform and works in real time. And there are more initiatives going on. On the private sector, in Deutsche Börse, we've renewed trading platform with the T7, which is used by a number of exchanges in the group, C7 clearing. In 3 weeks' time, we're moving the Repo clearing of Eurex clearing towards the new C7 platform. Brand new technology as well. And Deutsche Börse is also working on D7, which you might have heard of, D for digital. So that's building a complete market infrastructure for digital assets from issuance down to settlement. So that's something we talked about in different panels and preparation. So at least those kind of initiatives prepare for what the market is asking for, maybe faster settlement, but to settle securities on the blockchain, it would be much easier if the whole process is done under new technology and on digital assets. So settling bonds which are held in Clearstream Banking Frankfurt by the Ministry of Finance on a blockchain is going to be more difficult. So if the assets are first issued digitally and then progressively we go through the market infrastructure, and that's what we have started to build with D7. So that's just for the private initiative of the group, but there are plenty of other initiatives and infrastructure change or service provider coming up with new solutions. Entering the conference hall here, you might have seen a number of panels with brands and systems and so on, from Cloud Margin, WeMatch, HQLX, which are venture investment of Deutsche Börse Group, which we believe we could not do internally first, because there are great initiatives, so we're supporting and investing into those alternative solutions because they bring something new, and that's something which is giving me hope. At some stage, however, we're going to need a bit of hope, and I know Guido is there, but when you saw this morning they made an announcement that WeMatch and HQLX found an idea for partnering and joining forces to bring solution to client. That's what we need. So over lunch we talked about competition between competitors having to work together on partnership. In the collateral space, I talked about the big cost it creates. We need to improve the market infrastructure, but also the service provider to work together and having less solutions to please Emma, but not only, because everybody is asking not for more, is asking for less. So you don't one provider who does more things than another 15 new providers that you have on board and select individually and pay 15 different bills. So that's, I think, there should be and there will be, for sure, a consolidation phase in the collateral utility space. And settlement might not still be to your taste, Gareth, but if T2S, Euroclear and Clearstream, that's fine. That's 95% of the settlement in Europe happens on those three platforms. So that's already highly consolidated. And maybe so far we always preferred competition, at least the market preferred competition than monopolies. So that's fine. In the collateral utility space, I think we need to have that kind of consolidation, so to improve collateral optimization for all market participants and mobility, and also reduce the cost of monitoring and operating collateral management. That's key.
How many minutes have you left?
Sorry, it was long.
Because I can't see it from here.
9 minutes?
9 minutes, okay. So the one question I really want to ask to Thomas, ESG, from the Repo perspective, and it was mentioned by Brian, it will be discussed later by Zan. What can you tell us about it?
I think we, as a repo market, need to spend time to explain what the repo product is and what it can do for ESG as a space. I think there's a lot of people who have different opinions about what it is, what it means, and we need to help them to understand that the repo is split up, and we have had a very, very good set of working groups under ERCC of talking about these things very openly, because people had different approaches to these things. And I think it's really important just to start out with the idea that, the acceptance is that there is a bunch of investors who have a set of preferences. They're there, and we can meet these preferences and offer products to them, but we need to help them to make sure that they really get what they want. So we need to ask them some questions about what it is that they're really looking for in that space. So I think the first job that we have is to set up a set of, it was alluded to in Pascal's speech, that there are some standards, or at least some sort of agreement about this is this, this is this, and this is this. And then we can start having discussions about how we construct more of it and move forward. Because one of the things that we have as an experience from the repo market is that it's very easy for us to define asset classes based on the legalities of issuance. It's either fixed income or it's equity. And then there's a bit of hybrids. But it's very clear regulatory-wise what is what. Then we have credit, which going back to Lehman, what we thought was AAA was not quite AAA because we outsourced it to the credit agencies. So we have the same situation here with ESG. We need some legislation. There are some. We need somebody to help us categorize what is what. Some sort of agency that could be on the hook. Maybe they could be public. Maybe they have to be private. But at least we agree on what it is that they measure. Do they measure KPIs on the company you're trading with? Or is it a proceeds repo? Or is it the collateral that has certain characteristics? All that is very fluid at the moment. So it's very easy for people who think that ESG should not happen, and unfortunately there are still people out there, they can give us, we can very easily be accused for being complicit in greenwashing. And that is terrible because that's not what it's all about. It's about the investors with a certain set of preferences and giving to them. And then we don't have to get into any discussion about this or that. So I think we have a lot of work to do, but I think we've done a lot of work already. And if we grab this one really by the horns and get engaged as an industry, buy side and sell side in the forums, we can contribute a lot and steer the discussion and make it advance a lot quicker than it otherwise would have.
This must be like music in the ears of Zen, no? After the 1 year we spent on this. So we're going to have to finish, but I have here a repo desk as the gatekeeper, right? Emma, you mentioned T-bills from the ECB. Can you elaborate on that? And then...
Well, I think when we were just talking about the RRP facility, I think I was just trying to say that that is very challenging, a good option, but I think there's lots to implement, and I think the implementation around that could be challenging. So I thought, another way to help with the reserves would be, ECB, they've issued T-bills before. It's not like the plumbing doesn't work. It's there. It's a tool. And I thought that might just be easier for implementation.
But if I remember the meeting last week, Gerrit, you weren't very favourable for that. I'm challenging you now.
I know.
Why, you think that taking the grass under your feet away from your business?
No, I don't think so. And back to the gatekeeper question, right? I don't see the repo desk as being a gatekeeper. I see the repo desk as being like if all of the desks within any financial institution are cogs as part of the financial machinery, right? And that's connecting with other machinery, which are other financial firms. Then repo, funding, and collateral is the oil. It's the oil keeping that machine moving, right? And if the machine starts to seize up and collateral stops moving, liquidity stops moving, and the machine starts to seize up, and we see that first in prices, and that's where we then think, okay, is T-bills a solution to rates? But I don't know if that would be a solution. Could it be implemented quick enough within the European environment, for example? But yeah, no, not the gatekeeper, but the oil.
Thomas?
Gatekeeper of what? Because I think on some things it is oil and machinery, but other things, I think it could be the gatekeeper for, as I mentioned before, being more assertive with the regulators and saying this is going to have adverse consequences. We see it because we can see when there's sand in the oil, right? So we should be perhaps more vocal and just
even more. And I get accused that I'm too rough.
No, but I think we should say to them, we know we are, but listen, we do think that sometimes we don't necessarily know better, but we see more. So here it is, right? The emperor has no clothes. We need to sometimes be able to be that blunt.
But they have EMIR, they have SFTR, they have everything now. They can see everything, the regulator. Maybe they're not looking in the right place.
Sometimes it's probably overload, right? Because the amount of data that we are,
chewing.
Yeah. But on the gatekeeper, and come back to what Gareth said earlier about the multiplicity of desks, the difficulty to optimize collateral in a big firm and even in a small firm because there is always different flows of in and out of collateral. But more and more, rather than the repo desk, maybe you should refer to the collateral desk. But in most firms, you have solved the problem through treasury for cash. Most firms successfully manage their cash quite centrally with a treasury desk. So to me, for decades, we've heard cash is king. This morning on this panel, we heard collateral is king these days because of the scarcity and so on. Whatever, there will always be a change. But at the end, firms being large buy side or sell side should manage collateral like cash. So treasury should manage both asset class and not making it something different through the repo desk. And repo desk would be just one of the multiple desks which works on cash and collateral, like many other, like derivatives and so on. But I think increasingly, and that's going to be difficult, and that's why I'm calling for consolidation in the solution we provide around collateral. And I'm not talking about settlement or custody, but at a high level, to allow clients from any kind of size to optimize their collateral widely among their firms and making it a treasury function. So in many firms it's the case, but in very large investment banks or large banks like you have or asset managers, it's difficult. But that should be the aim. You know, we can consolidate US dollar position in cash or euro position or Japanese yen position. It should be the same with collateral, maybe with different buckets. But
okay, so we're going to stop here. We're all around for those who want to ask questions because we can't see anybody here. So maybe there's nobody left.
Some people, don't worry.
Maybe there's nobody left. We're going to stop here. We give the floor to Alex and the people from ICMA to give you information about what are the different projects doing. And then we hope we can keep the dialogue with the community. We are here to represent the community. There's elections the end of the year again. This is worse than political elections, the ERCC. There's always new participants coming in. Everybody wants to keep his seat. There's people advertising, throwing dinners around and everything. So it's an exciting market to be in, even if some people are getting a little bit older here now. But I thank you, the audience, for their attention. Thank you for the panelists, and speak to you later. Thank you.
Okay, thanks Gottfried, and to the panel as well. That was a very interesting and entertaining session. So I'm Alex Westphal. I'm the secretary to the ERCC, and I'm pleased to be joined today by my ICMA colleagues. This would have been a nice opportunity to introduce our new colleague Dina Saudi, who joined us in August and is now in charge of the legal work around the GMRA as the successor to Lisa Cleary. Unfortunately, Dina only made it to Frankfurt this morning with the fog in Luxembourg, but we'll circulate after the event a recorded update done by her.
Hello everyone, I'm Dina Saudi, Senior Director and Associate Counsel ICMA, and today I'll be providing you with the legal updates on ERCC activities. The first topic I'd like to discuss is our legal opinions. As you'll know, our legal opinions provide ICMA members with access to a substantial body of legal know-how in relation to the enforceability of the GMRA, and in particular the efficacy of its netting provisions across almost 70 jurisdictions. In April, we published the 2022 legal opinion updates, and following that in May, we also published a bespoke opinion for Armenia. We're currently working on a number of interim legal opinion updates, including in Finland, where there have been recent changes to corporate and debt restructuring legislation, and in Italy, where a new Italian code for business crisis and insolvency has been enacted, and we hope to be in a position to share those shortly. In the Bahamas, where new banking resolution laws presented issues for netting, ICMA, along with ISLA, ISDA, and local council, sent a letter to the governor of the central bank making some recommendations, which we understand have been received well and are awaiting further update. Previously, we have discussed the development of the repo markets in Nigeria and Ghana and are exploring the possibility of obtaining new legal opinions in those jurisdictions. At this stage, it seems likely we'll be able to progress an opinion for Nigeria, but seems we'll need to continue to monitor developments in Ghana and perhaps consider this again for the following year. In terms of other new jurisdictions, I've had an indication of interest in Kazakhstan and Egypt. For Kazakhstan, preliminary discussions with the Council indicate a positive outlook. We'd welcome member feedback in terms of these jurisdictions. And with that in mind, I should also mention that the annual legal opinion update for 2023 will commence shortly. So again, we'd welcome your timely feedback on the jurisdiction and counterparty coverage of the opinions, and would ask that you get in touch directly if you have anything to add here. Moving on to the clause taxonomy and library project. Whilst the GMRA is the foremost agreement for documenting cross-border repo and is published as a standard form, it is of course subject to negotiation in order to agree commercial terms, but also to reflect in-house positions and standards. The clause library project in its initial phase considered 10 clauses of the GIMRA and collated market variants, which were grouped by business outcomes and suggested model language created. Following completion of phase 1 in May of this year, we published a white paper setting out the outcomes of phase 1 and the objectives of phase 2, and also contextualizing the work in terms of use cases. Hopefully you've all had a chance to read it, and if you have and have any feedback, please do let me know. Phase 2, which is due to begin this week, will conduct a similar exercise to that of phase 1, considering the remaining clauses of the GIMRA, collating market variance and the differing business outcomes, and producing model language. Once the clause library is completed, the output from the project will assist in streamlining document generation and negotiation processes, as well as providing ICMA with an insight into documentation and market practice and its variant forms. And later it will support data modeling and extraction initiatives and form part of the digital ecosystem, including the CDM. Members are encouraged to get involved, so if you have not been part of the working groups to date and would like to join in phase 2, please do get in touch. D2 Legal Technology that we worked with on phase 1 will continue to work with us to complete phase 2. The final topic I want to cover today is digital assets. The growth of digital assets continues to accelerate, and we are aware that other trade associations are active in this area. For instance, most recently, ISA announced that they have appointed Ashurst to conduct preliminary analysis on the CMISLA within the digital asset landscape, and it is anticipated that a white paper will follow. I understand that digital assets in the context of Repo and the GIMRA have been raised in the past, but that there was not a member mandate to take this forward and not regarded as a priority at that time. At this stage, and with market developments as they are, it is likely that that has changed. And if so, we think it would be prudent to consider an exploratory paper that could consider the key principles that underpin the GIMRA, such as title transfer, netting, set-off, early termination, and the operation of those provisions within the digital landscape, as well as considering issues such as what the definition of digital assets actually is. Is that currencies or tokens, for example? We invite members to share their thoughts and suggestions in regards to digital assets and what you would think would be beneficial in this context. Thank you for your time today, and if you have any questions or would like to discuss, please do get in touch with us. Our details appear on the screen now. Thank you.
So what we wanted to do in the second part is just to run through some of the key topics and initiatives that we've been discussing within the ERCC this year. Quite a few of them have actually been mentioned already. In the past general meetings, we did this in the form of pre-recorded updates, unfortunately, but since we're all back in person, we picked up an idea from the previous physical AGM that we do this in some sort of panel form. We will still be using slides, and obviously it will be a little less interactive than the previous panel. It's not surprising, but we'll try our best to make it a little bit engaging. Let's first look at some figures and charts. Our European repo market, now in its repo market survey, now in its 43rd edition, not published yet, but Richard, you're giving us a bit of a sneak preview today. Over to you.
Thanks, Alex. Yeah, we have one more bank to come in, and you know who you are, and we look forward to getting your return. First thing I should say is the survey measures outstandings. So this is on the close of business on the survey date. It doesn't measure turnover or flow. So we understate things, short-term transactions, electronic, CCP cleared, but we picked outstanding because it's better. It's an open interest measure. It gives you an impression of risk. So you have to keep that in mind. So this is the trading analysis, and you can see that direct business at the top, since the global financial crisis, that's been growing. And this is where the D2C business is. This is long-term repo. This is credit repo, this is structured trades, this is relatively high margin stuff. If we move down to the red line, ATS, this is automatic trading systems. So this is BrokerTech, MTS, and Eurex repo, and a couple of others. It doesn't include the automated, mainly D2C systems like TradeWeb or GLMX. And this is, as I said, mainly D2D. It's very short term, it's government collateral, it's plain vanilla. So this is interdealer liquidity and collateral management, which is relatively low margin. It's stuff you have to do. Now, the trend since the global financial crisis, the trend since the beginning of the survey has been up. Now, that early climb is initially just organic growth. These are systems introduced in 1999, 2000, and they're establishing themselves. And then, of course, we get to the global financial crisis, and there's an uptake. So most of this, virtually all, 99% of this ATS business is CCP cleared. So in a way, this statistic is a proxy for central clearing. And so when we get to the global financial crisis, that increases because people are interested in getting everything into CCPs. It's for that reason that when you get to 2015, we see a sharp fall in the ATS business. And this is risk on because we have the enhanced asset purchase program announced in coming into effect in June 2015, confidence is restored to the market, and people get, CCP clearing is expensive, so people feel they can dispense with it, or what capital they've got, they prefer to put into high margin business. And then 2018, we have a blowout in credit spreads, we have trade wars, we have all sorts of issues, and it's risk off, and you see the business go back up again. If we look at the very bottom, we see the orange line is tri-party. So this is largely D2C. There is GC financing business, which is dealer to dealer. So things like GC pooling, Euro GC Plus. And this is notably hit by the enhanced asset purchase program in 2015. The market is flooded with central bank cash. And so that tri-party business suffers. We do see a recovery in that tri-party business starting in about 2019. We believe a lot of that is new users coming into the market on the C side of D2C. We do get data directly from the tri-party service providers, and that shows a much larger recovery than we see in our survey, and that's because it's coming from people who aren't members of our survey sample. So it's the other side of the dealers who mainly report in our survey. But of course, it's still relatively small. It's nothing like the US. Tri-party is a different animal in Europe. And then the green is voice brokers. And this is a secular decline right across the survey period. And a lot of that is driven, at least initially, by the growth of ATS. So the growth of ATS pushes the voice brokers out of the commoditized end of the market, the short-term stuff, and voice brokers concentrate in longer term. Forward business is an important, perhaps 40% of their business, credit collateral and package deals with derivatives. But perhaps it's stabilized, we don't know. Prior to the global financial crisis, you could see that relationship. Electronic trading goes up, voice brokers go down. After the global financial crisis, it appears that the trade-off is between ATS and direct business, but that's a statistical effect. It's because they're the dominant shares, and so if one moves, the other tends to move. So we don't think that's a significant relationship. This is geographical analysis, and I have to emphasize, because of constraints on firms reporting, we don't know where the business comes from. We only know where it's going to. So firms often run pan-European books or regional books, and they find it difficult to break out which desk did what, but they can tell us where the business went to. And the dominant theme here is the growth of cross-border business to non-Eurozone countries, and that's sort of shorthand for London. And it's especially notable after the global financial crisis. And we think that secular growth in this part of the business is really structural market consolidation, people reorganizing, trying to centralize their liquidity and collateral management. The domestic business you can see in blue, that shows a decline until 2015. We think that's the counterpart to what's happening in the cross-border business. But then, and it's particularly hit by the Eurozone sovereign debt crisis in 2010, 2011, and then it's stabilized by the enhanced asset purchase program. Anonymous business, that's the dark blue. So this is, it's CCP cleared, but unlike the ATS business in the previous slide, This includes post-trade clearing, and which is very important in the European market. And so this series rises to a peak higher than the ATS statistic we saw on the previous slide. And this is very much a proxy for CCP cleared business. And what we see is that it rises, it stabilizes, and then you see it falls. And that's very much risk on. That's after the enhanced asset program. Then 2018, it bounces back. So we see the effects we saw in the ATS series, but it's far more noticeable. And then the final one is the orange line, and that's cross-border business to the Eurozone. And that declines until about 2020, and then it's recovered. We don't know really why it's recovered. It may be partly a Brexit effect, but I think there's weak evidence for that. The survey is at a very aggregated level, and sometimes if you look at the sea, it looks calm, but there are tremendous currents underneath, and I think that's the problem we have in the interpretation. If I look at currency analysis, we see a decline in euros until the global financial crisis. This is diversification. This is the market being relatively new currencies being brought in. And then we see a recovery eventually after the Eurozone sovereign debt crisis. And then you'll notice that drop that occurs in about 2018. Some of that is other currencies gearing up, sterling, dollars, yen. But we think the main contributor to that sudden drop is things like TLTRO and tiered accounts at the ECB. A lot of peripheral country borrowers don't need the repo market anymore. They've got more than enough cash from the ECB. So we think that accounts for that drop. I've got the thin red line is Japanese yen. It's the right-hand scale, so it's just to show you what's happening there. That's mainly a cross-currency basis-driven bit of business, but generally there is an increase in interest in yen. There's also a regulatory arbitrage in HQLA. And then below we see, sorry, the sterling and dollar labels are the wrong way round, but we see the gradual growth in that business as well. In collateral analysis, the big story, of course, is collateral scarcity, particularly of German government bonds, and you can see that there. And you can see quite a dramatic drop from 2018. Now, we saw the first big signs of collateral scarcity at the end of 2016. So why are our statistics not dropping until 2018? We think that there are a number of reasons for that, but do you know, I think I forgot. Oh, yes, it's the risk-on phase. People were quite happy with the situation up to 2018, and then we get that, as I said, there's various circumstances like credit spreads blowing and the threat of trade war and so on. People became more scared, I think, and so the hoarding of German government bonds became more serious from 2018. We see French collateral increasing as a substitute for German collateral, and then that starts to become scarce for the same reason, and we see that effect in Dutch collateral as well. Now, I just mentioned the Spanish collateral, that's the orange line. There's a structural shift during the global financial crisis. Spanish banks decide repo is the way to keep their liquidity assured, and they go in a big way, and they start joining CCPs, and we can see that there's that jump at that time. Collateral analysis, this is some of the other major collateral. So UK government collateral, it's bounced around a bit, but the final phase, that growth, a lot of that's to do with post-Brexit trading, and it's stayed at a relatively elevated level. US collateral, that's jumped and bounced around a bit, but it's here to stay. But what I'd emphasize is whether UK collateral is about the same size as sterling and Japanese collateral is about the same size as yen. In the case of US collateral, it's much smaller than the US dollar contribution. So a lot of US dollars are traded cross-currency. And then we've seen the yen diagram. Now this is overall government bonds as a percentage of European government collateral. We can see a decline and a nadir reached during the global financial crisis. This is because people didn't trust peripheral government bonds anymore, so there's less stuff being used. And then there's recovery, and then we see that jump in government bonds. That's confidence restored by the enhanced asset program, people going back to using more Italian and Spanish and other government bonds like that. And then more recently, from 2019, we've seen a little decline and then a bounce back. That's the TLTRO and tiered accounts at ECB effect. And then maturities. So these are, for the last, I forget how many years, but all the grey is previous surveys, and the red is the latest in a particular maturity bucket. And what I'd point your attention to is the fifth bucket from the left, and you see it's very spiky. This is 1 to 3 month collateral, and it's highly seasonal. You know, we know what it's going to do. In the December survey, it jumps. In the June survey, it falls. And this appears to be where people often trade 3 to 6 months. It's between trade 1 to 6 months, but mainly 3 to 6 months to avoid LCR and to avoid NSFR, or to avoid the step up in NSFR at 6 months. And I think it ends up in that 1 to 3 month bucket in our survey. So that's highly seasonal. Then note the 1 week to 1 month bucket. That's generally been declining, and in fact in the last survey there's been quite a significant drop in that business. 6 to 12 months has also gone down. The 12-month business, there's a spike. That's the second from the right. There's a big spike after various crisis periods as people went into turn business in a big way, but that's subsided. And then the final thing there is the right-hand bucket, which is forwards. Now, that's gone over 20% in outstanding of the survey. Originally, forwards would have been used for interest rate positioning, and perhaps they are coming back into that now. But we think for most of the period after the enhanced asset programme was introduced, it's collateral management. You're locking in collateral over end year. However, the figure is distorted because it would appear that a lot of the forward business is in fact people doing long-term transactions and then breaking them up into, let's say, a 1 year trade into 1 to 3 months, and then 3 to 6, 6 to 9, 9 to 12 to improve netting. So some of it's false forwards, but it's definitely a significant market. And then finally, this is the weighted average maturity, minimum, maximum. We can't calculate the exact figure, but we can do the minimum, maximum. And you see, obviously, during the post-crisis periods, people locking in long-term liquidity, and then as confidence returns, that subsides, but recently it's come back up. One thing I will finish off with is to try and detect the effect of the COVID crisis on our statistics is really very difficult, because everything happens so fast within, we do a semi-annual survey, and so we have the crisis in March, very rapid official response, and it's largely disappeared by June if you aggregate the figures. There are slight traces, but this is one of the limitations.
Thanks, Richard. So with that, let's move on to everyone's favorite topic, the latest regulatory developments, and one has been standing out a bit, of course, over the past months, CSDR and MBIs. Quite a lot has happened, and for once, some positive developments. So, Andy.
Yeah, thanks, Alex. As I'm sure everybody is aware, CSDR, in particular mandatory buy-ins, has been a big priority for ICMA. It's been managed through our Secondary Market Practices Committee, but obviously it also has implications for Repo and SFT market functioning as well. The good news that Alex mentions is, of course, the fact that MBIs did not go ahead in February of this year, as had originally been intended. There is always with MBIs some bad news, and the bad news is they have not quite gone away yet, as was alluded to on the panel earlier. Now, in March, the Commission published its CSDR refit, which included a rework of MBIs, and under the new regime, they propose what they're calling a two-step approach, which means that rather than go straight to implementing mandatory buy-ins, what they will do is assess settlement efficiency rates along certain criteria, including comparative analysis with other jurisdictions, notably the US, and then decide on a market-by-market basis whether or not MBIs should be applied. They also fixed some of the issues that we'd flagged for a long time, such as the the asymmetry, the ability to have pass-ons, which is also linked to the asymmetry. Now, we still believe that there is a hope that we can get rid of MBIs completely, and that is where we continue to focus our advocacy. At the moment, the Commission proposal is being considered by the Council and the Parliament. We are involved in outreach to both, and we are still advocating that MBIs be removed from CSDR and settlement discipline, that ultimately, if it were ever implemented, it would affect liquidity, it would affect market functioning, pricing, and it could ultimately be market destabilizing. Also, it would likely undermine Europe's competitiveness as a global marketplace. That's the main thrust of our advocacy. We also have a fallback, which is if they decide that they will continue and go ahead with this two-step approach, there are a number of refinements we think they need to make. One key one is we would like more flexibility in the two-step approach, including possibly recalibrating penalties, as was also mentioned a bit earlier. Maybe the penalties are not quite at the right level. So we'd rather they do that as an intermediate step rather than going straight to MBIs. Another very important refinement that we're proposing, and should be of interest to everybody here, is the total exclusion of SFTs from scope. We think this makes no sense whatsoever. As a final refinement, we're also suggesting that in the event MBIs do go ahead, they don't implement it through CSDR. It's buy-ins are not a post-trade process. They're a market transaction, and therefore between market regulated entities, so therefore if it's ever implemented, it's better done through market regulation. So I'll just wrap up with a tiny bit more of good news. Many of you will have seen that the ECB published its opinion on the CSDR refit at the beginning of August, and I don't know where they've been for the last 7 or 8 years, but the good news is they are very much aligned with our position and also suggest that MBIs are a bad idea and should not go ahead.
Good, so we'll have to probably wait and see how big a theme this will be next year still, or if it's just ticking the box.
Absolutely.
Good. And as it fits so well, let me also add a few words on our settlement efficiency work, which was already mentioned earlier, which we see as an important complement to the work or to the regulatory discussions on buy-ins and CSDR more generally. As was mentioned, it's been a long-running initiative within the ERCC and also discussion. We presented this in the past. It's driven by the ERCC operations group, but also involves all the other relevant groups, including the committee, of course. So as a brief recap, we held a series of workshops in 2021, and then based on the outcome of those, we published the discussion paper that you see here on optimizing settlement efficiency. That was published in February on the day of the CSDR penalties go live. So in the paper, we look at the various, at the underlying data, even if it's relatively limited, on settlement efficiency and the different measures. But more importantly, we focus on a number of optimization tools. Again, they were mentioned before by JR and others that we think play an important or particularly important role to support settlement efficiency, including shaping of settlement instructions, auto-partialing and auto-borrowing. So we look at the usage and the different constraints. As part of this initiative, we also updated and strengthened our best practice recommendations on the Repo side, on the usage of all those tools. So that was all in February. We've made some further progress since then. And I would mention 4 points here. First of all, the whole analysis was presented, and the recommendations as well, were presented to ICMA's Secondary Market Practices Committee, the SMPC. And there was quite positive feedback, and as a result of that, we drafted and then adopted with the SMPC equivalent best practice recommendations for the secondary bond market. So I think that's an important step to have that kind of consistency across instruments. Now that the CSDR cash penalties are live, we also run a series of follow-up workshops with members. First of all, to look at progress more generally on settlement efficiency and the impact, of course, of cash penalties, but also more specifically to look at the usage of the different tools that we mentioned and how that has evolved. So in June, we held the first workshop focusing on auto-partialing. And the second workshop is also already scheduled for the 7th of October, where we'll be looking at primarily at auto borrowing. Then third point, a very important element in all of this is data. It's still quite difficult to get our hands on proper data. It's still quite limited. So we have to rely obviously on the infrastructure providers. The ICSDs are fully involved in this work and they've been really helpful. But we also had good discussions with the ECB and T2S. They're running their own settlement efficiency work stream where we are involved. So that's definitely very helpful. And then the fourth point, we're also working on another follow-up paper, which looks at the three tools mainly that I mentioned and the progress with those. But it also goes beyond and looks at other settlement efficiency drivers that we've analyzed as part of the whole initiative. So hopefully you'll see that within the next, let's say, 2 months. Now, CSDR is obviously not the only piece of regulation that we're looking at. A number of other issues have been in focus recently, and two of those, one was the EU capital requirements regulation, the CRR, and the ongoing review, and the other one, the MMF regulation, which I think Emma already alluded to earlier. So Andy, can you just take us through what we've been doing in that context?
Yes, happy to. So in October, as I'm sure you're aware, the Commission published its new banking regulation package, which is a final installment of Basel 3.5 in the form of CRD6 and CRR3. Now, CRR3 unfortunately introduces a 100% risk weight for uncollateralized SFT exposures to unrated non-banks under the standardized approach. That is essentially the haircut element. We see this as being problematic given the introduction of the output floor as part of FRTB, which means that even banks who use their internal models will still have to absorb 72.5% of this new calibration. So we are arguing that to be consistent with other parts of CRR, and particularly CRR2, 100% weighting is way too punitive. We are pushing for a friendlier treatment of 20% for exposures under 3 months and 50% over 3 months. So recognizing the short-term nature of SFTs, but also the importance, which again, we heard about very clearly in the previous panel. Now, the good news is we seem to be getting some traction. The French in the Council seem to be very supportive of this. We don't really have a read on how other council members are positioned, but importantly, we did reach out to a number of MEPs, and in August, 6 different MEPs put forward amendments that were perfectly aligned with our suggestion. So we'll continue to monitor this, but again, hopefully this is good news from as part of our.
Before you move on, Andy, do you want to say perhaps a word about the kind of cost estimations that we did as part of that advocacy effort with members as well?
Yeah, because I think that is quite critical. What does it mean in terms of real cost? And working with some of our members, we crunched the numbers on how this would look based on a 5% haircut, and how this would reprice repos under the internal model. And it doesn't sound huge, it's about 3 to 4 basis points. But if you think of 3 to 4 basis points on a short-term sovereign bond repo, where the bid-ask spread is 5 basis points, 10 basis points max, that's quite significant. So it's definitely something that has quite an impact.
Okay. MMFR?
Yes, this is something Emma mentioned on the previous panel. Now, money market fund regulation, or the RTS, requires that money market funds, EU-regulated money market funds, receive a haircut whenever they receive collateral through a reverse repurchase agreement. The regulation also sets out a number of exemptions, including in the case of dealing with a CCP, which makes sense. It's very difficult to ask a CCP to give a haircut. Now, the problem is that the regulation, which perhaps did not envisage Brexit, only provides this exemption for EU-regulated, EU-authorized CCPs, and not EU-recognized CCPs, which means if you are a sterling money market fund based here or in Dublin or anywhere in the EU, you cannot have access to LCH for sterling clearing. Now, was this intentional? Probably not. We've raised it with the Commission. We're having constructive discussions with the money market fund team in FSMA. They're aware of the problem. We've provided additional information and also about the importance of access to clearing for money market funds, and hopefully we can progress this discussion.
Okay. Do you think that this is, from the feedback from the discussion, do you think that's really appreciated by the Commission, the importance of these third country CCPs? I
think at a working level, yes. The problem is to make the change, and the change would be relatively simple. It would just be going back to the regulation and adding EU-recognized CCPs as well as EU-authorized CCPs. The problem is political, and personally, I think that's where it might get very, very tricky, particularly in the current climate, and I'm not optimistic over the next 2 years that climate's going to improve very much.
Let's see. We'll keep on trying. Now, before we move on from regulation, I think you would be all surprised if we wouldn't at least mention SFTR. So just to note that work is still very much alive and kicking. Our recommendations are still developing and growing. Richard will attest to that. Holding the key, the pen. So yes, the task force still is meeting on a monthly basis. We still get around 100 participants at each call, which shows, I think, very well that there's still a lot of work to do. So there, just to note that definitely that's not forgotten. It's still going on. Now, with that, let's move on to the next topic, and that is fintech and digitalization, looking a bit at the broader work that ICMA does in that space, but also specifically at Repo.
Good afternoon. I'm pleased to share an update on ICMA's fintech initiatives here at the ERCC General Meeting, in particular on the CDM for Repo and Bonds, Phase 2, Wholesale CBDC, the DLT and Blockchain in Bond Markets FAQs, and the Common Data Dictionary. For those who don't know me, my name is Gabriel Carlsen. I look after ICMA's Fintech Advisory Committee and its DLT Bonds Working Group, and I've also been leading ICMA's CDM project for Repo and Bonds. We are now halfway through Phase 2 of the CDM for Repo and Bonds and have made good progress. As you know, the focus has been on open repos, floating rate repos, and evergreen repos. ICMA's CDM Steering Committee held regular meetings between May and July to draw up workflow models of repos, for example, of a re-rate and its different variations, repricing, but also collateral substitution and termination of an open repo, amongst other lifecycle events and processes. So the first modeling stage has been completed on schedule. Since August, we have been working with Regnosis, a technology firm, to translate these repo workflows into the model. And the benefit is that by using the CDM's unambiguous and codified representation of a repo transaction, market participants will be able to automate manual processes, reduce costs, but also explore novel technologies such as DLT that rely on a standardized representation of transactions. We also held a webinar in July on how to implement the CDM. For those who are interested, it is available in our media library, and we are planning to hold another webinar in the coming weeks. In parallel, ICMA, ISDA, and ISLA have jointly appointed FINOS, the FinTech Open Source Foundation, to provide a repository for the CDM in August, following an RFP process. The three associations and FINOS are working together with a view to transferring the CDM code currently hosted by ISDA to FINOS by year-end. So, in terms of next steps, the next CDM steering committee meetings will take place on the 15th of September, the 29th of September, and the 13th October, on the Thursday from 2 to 3 UK time. And the main focus will be on modeling evergreen and extendable repos, general collateral, and tri-party repo processes. Additionally, we are in the process of developing a CDM proof of concept for repo trade confirmation. And the aim is to bring the concept of the CDM to life and demonstrate the use of the CDM in formulating a repo contract and sharing it with counterparties for confirmation and booking. There will be a potential showcase opportunity at the joint ICMA-ISDA-ISLA CDM industry event, which will be held in January 2023. So if you would like to participate in the CDM steering committee going forward to shape the CDM, or if you would like to participate in the POC, please do get in touch. And for those who would like to learn a bit more about the CDM, further resources are available on ICMA's website. So beyond the repo and collateral, ICMA has been very active over the last few months. Our DLT bonds working group responded to an ECB consultation in relation to wholesale CBDC at the end of June. Members were overwhelmingly in favor of a wholesale CBDC. As a follow-up to the consultation, ICMA participated in a virtual meeting with the ECB and other respondents on the 8th of September. ICMA has also prepared an FAQ document on DLT and blockchain in bond markets, with substantive contributions from its DLT bonds working group. The document is due to be published in September, and it is designed to serve as an entry point for non-experts who want to gain a better understanding of DLT and how it impacts bond markets. The next meetings of ICMA's DLT bonds working group will be held on the 5th of October from 9 to 10 UK time and the 24th of November from 9:30 to 10:30 UK time. ICMA's Common Data Dictionary Working Group has held regular meetings over the last few months to build consensus on key bond information so as to promote STP and interoperability within the primary issuance process. The initial use case are vanilla bond term sheets covering around 80 data points to be delivered in machine-readable format. The next meeting will take place on the 26th of October from 3:30 to 5 p.m. Again, if you would like to contribute to any of those initiatives, please do get in touch. Thank you for your attention.
So from fintech, first of all, to another really important issue, as we heard earlier as well in the panel, the role of the buy side in the repo market. So to give that a bit the necessary attention. We held a series of workshops, Andy, that you coordinated. So over to you to give a bit of an update.
Thanks, Alex. I'll provide a very brief update. I'm conscious of time. But as you say, this relates directly to some of the themes coming out of the previous panel and some of the concerns of the buy side around access to repo market liquidity. So we held 2 workshops to focus on some of these challenges. The first one was in February, which was open to all buy-side members, and in fact non-members as well. And that involved all different types of underlying buy-sides, where we talked about how they access the market, why it's important, and the various challenges, including intermediation, which is probably the biggest hurdle, particularly at certain points in time, like year-end. Then we held a follow-up workshop in May, and this time we invited along the sell sides and also the FMIs from the committee to talk about some of the issues that they face, but also to look at some of the potential solutions. So we've produced a note of the 2 workshops. The plan now is to develop that into a white paper. We think that will probably involve maybe a further workshop, or certainly more input from our buy-side community. And then we would like to use that as a basis for advocacy or education, as Gottfried described it earlier, for policymakers and regulators to have a better sense of some of the problems the market faces, some of the structural issues and the risks being posed to market functioning. And then we're thinking that maybe later in this year, if not beginning of next year, we can hold a workshop with the regulatory community, and where we can discuss some of these issues. Okay.
Well, there would be potentially lots of follow-up questions, but we don't go into that now. Certainly, we want to give John the opportunity to talk about repo and sustainability, which she was already mentioned earlier. John has been leading for us a very important topic. 2 years ago, it was still virtually non-existent, but since then we had lots of engagement from members, really interesting and, as it was mentioned, heated discussions, but it's obviously not very easy always for you, John, but do you want to take us through maybe what we've been doing so far?
Sure, thanks, Alex. Sustainability has definitely become a focusing area for many firms. And as mentioned in previous panel, the ERCC also recognized the growing importance in this field. And since last year, we're really trying to drive this development in the repo space. So as many of you know, we published a consultation paper last year, and then subsequently we also launched a market survey which promoted a broader discussion on the topic. And building from that consultation result, in the beginning of this year, again, as mentioned, we launched a task force on repo and sustainability jointly with the ERCC and also ICMA's Executive Committee of the Principals to really dig deeper into some of the themes or questions that have been raised from the market survey. And the main objective of the task force is really to provide this platform for the industry to discuss the topic and also to build towards best practices or guidelines in the future if needed. And the task force now consists of 50 firms. Again, like we're just getting more interest from a lot more firms. And 3 coordinators from BNP Paribas, Eurex, and TD Securities are kindly helping us to drive this work forward. And as the first public outcome of the task force, the group really decided to reflect on the recent market development and to provide a paper to outline some early observations and also high-level categorizations on the different intersections between repo and sustainability. Again, as mentioned earlier, it's very important to do this exercise to provide further transparency and information for the market and also to just ensure the consistencies in communicating communication and also to avoid misunderstanding on ESG repo-related topics. So we really looked from two perspectives. One is the wider sustainability considerations within the existing repo business, so through the differentiated treatment of collateral and counterparty. And secondly, it's really the specific sustainability financing repo products that have been appeared in the market. So more or less in line with what we described in our original consultation paper. So you have the use of proceeds repo, where the cash proceeds are invested in sustainable projects or assets, and also the sustainability-linked repo with the variable repo rate to encourage borrowers to meet their ESG KPIs. Sort of looking ahead, I think the repo market is definitely being more active in the field. And so as of the next step, we will obviously publish the paper, close monitor the market revolution, and continue the discussion. I think why is this so challenging, as you said? I think compared to the bond market or maybe just primary market in general, the repo market is still at the early stage. It's just starting, but there's no doubt it has an important role to play. And a lot of the existing market standards can be utilized for the repo as well with the correct adjustment. I think we will just continue to provide clarity, encourage transparent communications, see how the market grows, hopefully to see more transactions as well coming before we could maybe progress to some proper guidelines in the future.
Okay, thanks very much, John. And there's only one more topic to get through, and I can keep this very brief because Brian in his introduction already mentioned most of the points that I have here on the slide. But we're very pleased and convinced of the idea of launching this new forum, the Global Repo and Collateral Forum, the GRCF. It's been quite a long-running discussion within ICMA that we have a bit of a disconnect between the global nature of lots of the topics that we're talking about, including the GMRA, of course, but also other key themes like digitalization and also sustainability. And the fact that there's a bit of a lack of a forum to engage also on the repo and collateral side with non-European members of ICMA, and obviously our membership becomes ever more global. So the idea is to launch this, the GRCF. A couple of points, important points to mention, and again, Brian mentioned some of them already. The plan is to establish this as a very open group, so no elections like for the ERCC committee, a less structured governance. And we want to also keep this very flexible in terms of structure and format to take into account the feedback from members and to make sure that this is as relevant and interesting as possible. And so we really aim to be guided by member feedback on this. Also very important, the objective is clearly to make this complementary to the ERCC. It's not replacing the ERCC in any way, which we will keep, which is of course remains at the core of everything we do, works very well, and the remit is also appropriate. It's really just an additional forum. At the same time, we hope that it is interesting not only for non-European members, but also for European members, in particular those that are not perhaps directly involved on the ERCC committee. So we'll see where things go. We'll send out an email in the next few days, probably, so please keep your eyes open, and that will be an invitation to sign up. And we hope to have the inaugural meeting of the GRCF virtually, obviously, in November. So in the meantime, again, any feedback or ideas from your side would be very welcome. We have a number of ideas where this could possibly go, but again, feedback and suggestions would be very welcome. So we'll conclude here. Thanks again to everyone for attending, and I give the floor back to the Master of Ceremony, Martin, for the concluding remarks.